Good. Hey, I'm really excited to be here for our second bi-monthly Core Talks, which really is all about empowering private capital markets from the issuers to the investors to the intermediaries that make it happen, all while utilizing the Jobs Act and Regulation CF and Reg A+. Today's topic has taken about 15 years to become pretty mainstream, and it revolves around the rise of ESGs. My co-host today is Paul Karrlsson-Willis from Invest Justly. And Paul's a veteran in the capital market industry with 20 years experience. So I'm really excited to get your insights, Paul. And Invest Justly, your name kind of says it all, I think, a little bit on the topic that we're going to be jumping into. So I'm going to kind of turn it over to you. Today's just going to be a real go back and forth, and let's talk about ESGs, and maybe we can discuss a little bit more about the definition, what it means, and the evolution of it. How's that sound for you?
Sounds great, Peter. And again, thank you very much for hosting this and putting this together. As you said, ESG has been around now for probably 15, maybe even 20 years. Various ways people have looked at it. But the investors over the last 10 years, as you know, have really started pushing towards re-looking at what values are and how you evaluate a company. In the old days, it used to be risk and return. Mm-hmm. Now it's risk, return, impact. And that impact is in the E on the environmental side, S on the social side, and G for governance. And I think we're seeing more and more of a push in that. There's more and more companies out there, nonprofits, like As You Sow, like B Corp Labs, or B Labs, should I say, that are evaluating and finding criteria to actually evaluate these companies now. And I think that's the exciting thing, that we're slowly getting into that position to be able to put criteria and evaluation around these companies.
Hey, so you talk about the environmental aspect of it. I mean, I've got family, I've got kids, and we hear about certainly my kids and my daughter in university. I mean, they talk about it all the time. They talk about social impact. They talk about the environment at large. What do you think's really changed? Because institutional investors were, back in 2007, they were talking about it. Where do you think it was driven from? Do you think it was driven from top down, or do you think it was driven from the crowd and the internet and communication at large? What's your take on that?
I think it's actually come from the investors. It's come from a new wave of investors, call them millennials. They have a different take on how companies should be run and value. As I say, the risk return and now impact. In the old days when, you and I were coming up through the business, it was always money, money, money. What is the return? Mm-hmm. How much money is this company going to make? How much profit? How much more profit can we get out of this? And I think over the last 10 years, you've seen a change that, yes, you can still make a profit, but is there ways that you can make a social impact? Is there a way that we can protect the planet, help society in various ways? So I think there's been a huge push coming from that generation.
No, I agree with you. I mean, I don't even know if it's just that generation. I think the general awareness of, even our generation. I mean, I'm a little bit older than certainly not in university anymore, but just that I see investments as you do every single day, or potential investments, because of the business that we're in, and new companies coming to presenting. I mean, and they tout themselves as ESGs, but I think the new startups are actually ESGs in the sense that they're building their businesses around, the environment, around the social side of things and governance, right from inception. And do you think they've got a leg up as far as that their ability to not have any legacy or infrastructure systems, let's say a large corporation has, and maybe we equate it to, let's look at an old traditional automobile manufacturer versus a Tesla per se. Mm-hmm. Tesla started with a mission, a vision from the ground up, and an environmental message, and seemed, everybody knows that they're leading the space. what's your thoughts in that direction? Do you think it's easier for a startup, or is it hard?
It's easier for a startup because again, if you look at a corporation that's been around 100 years, 50 years, they have a culture, they have a practice, and so you're now asking that organization as a whole to rethink a lot of the things that they've been doing for decades. Whereas you see these new young private equity companies coming up, these new businesses, they're already using the ESG elements, the governance and the social, about making sure they look after employees, the salary. It's already embedded in their culture as they grow, which is a lot easier. I kind of look at it from my old days as a soccer coach. Getting a team at 14 years old, they already had bad habits, right? You had to change their mindset to get them to do. And when push come to shove, they would always go back to bad habits. It was just a natural instinct. When I got a team when they were 6 years old, then that was so much better because I could get them to do how I perceived the game should be played. And therefore, it was so much easier because their first natural instinct was the first things that they'd been taught by me as a coach.
Yeah.
And I wasn't having to go back and re-educate and rechange that and get them the confidence to make that change. And I think that's the other key thing. A lot of companies want to make that change, but will it affect my profits? Is it really something that I should be doing? Or is this just a buzzword right now? Is this something that's just fashionable, and will it go away in 5, 10, 15 years? So you have all of those questions going on in these organizations that have been around a long time. But that being said, you mentioned Tesla. The other day, I saw all of these car ads. Every car ad was EV. It didn't matter if it was General Motors, Toyota, whoever it was. Everyone's selling EV now. And so that's interesting. I think, again, these companies have seen that's where the consumer has gone. This is what the people want. And therefore, they have met that demand and made sure they're moving in that direction.
Oh, yeah. I mean, you hit on so many different things in that. I mean, you talk about the kids, you talk about how much easier it is to, and it's so much more fun. I mean, sharing with the young kids and but I think there's a relevant point there when it comes to new companies that are starting up, because the CEOs and these founders and these principled visionaries that are looking at, the environmental impact, looking at the social impact and the government side of it, all of those things that ESG are all about. But do you think one of the things that I've seen recently, and we'll touch on where crowdfunding and private equity comes into play a little bit later on, but one of the things I've seen, you mentioned EV spaces, I cannot believe how many new electric vehicle and battery related companies and private companies that are starting up and presenting their niches. Maybe they're not all saying, I want to be a $1 trillion company, but heck, there's nothing wrong with being a $1 billion private company. And is there that space for more of those niches? And I think from some of the real exciting new initiatives and advancements that I'm seeing, I mean, when I see these presentations, I mean, it's as an entrepreneur and at the same time it's just darn cool. I mean, at the end of the day, I just see, from flying aircraft to this, that, and the other thing. And I don't think there's going to be one player. I mean, historically, I had concerns that, the market's going to be all gobbled up by the large corporations that just keep consuming. And we certainly see that in the public marketplace. I'm hoping anyway. I think the new private capital market opportunities with Regulation CF and Regulation A+ start that journey where companies don't have to become these big Goliaths, that own everything. And can you have a lot of niche, companies? And what's your thinking of that? Like, I mean, is there room for lots and lots of $1 billion private companies?
I think there is, to start with. I think if we look at technology and the way industry as a whole moves forward, normally when there's new ideas, there's a lot of new ideas out there and a lot of companies doing them. And then over a period of time, they start merging and start growing. Right now, we're in that learning phase, right? I mean, you look at Ideanomics, for instance, that owns Justly. They have Italian motorbikes, they have tractors, they have mopeds out of Malaysia, they have 2 or 3 different systems to power those vehicles. And the idea is it's an ecosystem. They share information, they help each other grow and produce a better product, and also be a little bit more flexible in doing so. And so I think you're going to see a lot more of that. You're going to see a lot more people come up with different power solutions, and we've got a few companies that we're dealing with coming to our platform or already on our platform, and they all have different solutions to being able to basically you and I to be able to buy an EV car and not sit around for 2 hours waiting for it to charge so I can go another 150 miles, right? So all of these things are going to have to happen, because again, if EV is really going to take off, then you need power solutions. You need good power solutions. One of the things Ideanomics has is Wave, which is actually in the road. So a bus can stop on it when it drops people off and charge at the same time, right? So solutions like that are amazing. And that's where the industry is going to go. But there is going to be a lot of companies coming out with those amazing ideas. And I think that's what's so good about the Jobs Act, which is 10 years old now, the crowdfunding, the Reg A. These companies are going to get the opportunity to raise money. And secondly, individuals that would not normally have had access to private equity now do. So the normal investor in the street can invest in these companies as they start and be able to grow with them and be passionate about them, because it's, again, having that impact and that social awareness that these investors want these days.
And I think that's, I mean, you're one of many companies that are focused on the environmental space. You and Ideanomics, and Justly more so than many. And so obviously there's more than what I would say an appetite. There's a large investment community. I think the public at large is looking at the ESG and saying, hey, we got to do things about this planet. And I am anticipating that. You just mentioned there's a lot of different technologies that are coming to play and different ideas. And does it have to be a winner take all, mindset? Will there be, they've got a great charging platform for the home. They've got a great charging platform for say that you talk about buses, say for commercial vehicles where, schools, they got their own bus platforms built into centralized depots for school buses. Does that have to be the same as what's going on in another space? Can you have a lot of more community-based businesses, maybe large, that are getting built out? We're seeing things, or I've certainly seen some things where small communities that say, how do we bring vertical farming to a community? Right. And, very ESG related, from an environmental impact. But you do that at a micro level. I mean, we live in this global economy, and other companies that I talk to on the large infrastructure side of the equation, they go, well, the biggest problem is containers are being shipped around the world empty to go back from a location because of whatever different logistical, issues. And what if, and now you get these, bright minds that are combining technologies and saying, hey, let's do an eco farm. Let's put it in, and it doesn't have to be that big. It's gonna service a community of, 500,000 people, for example, or it's going to be in a remote location and they can have fresh produce and vegetables. Those things to me are inspiring. I mean, I really get excited because it touches, the small communities in their backyard. It's not just I'm buying something, on the web and it's being shipped and produced overseas or wherever that may be. And there's nothing wrong with that. It's all part of the infrastructure. It's all part of where, the supply chains that we live in. But just the belief that the opportunities for those small companies to say, hey, I need to raise, we're going to dovetail into, I need to raise, $1 million, $5 million to do a test of this, to get it off the ground. Maybe we can just touch on something that you and I know and are pretty fond about, is back to the regulations that were discussed, a couple of weeks back with David
Yep.
Wheel and Oscar Joffrey was, and a lot of people, a lot of our viewers and listeners may not know. They say, okay, I've heard about these regulations again. I think it's always important to bring them back to the surface. And so, Reg CF, for example, they've upped the limits. You can private companies can now raise up to $5 million from a not accredited investor, and from the accredited investors, it's far less onerous as far as their ability to invest. From your standpoint, and you're doing offerings in both CF up to 5 million and Reg A up to 75 million. The average investor, from that perspective, where you've got thousands of individual investors investing in an impact project that they believe in, what are the average investments? What are you finding right now? And I know what our holistic numbers are. I'm just seeing what your experience has been. Well,
yeah, it's right now. I mean, certainly when you get into crowdfunding, it's probably around the 500 mark. Again, on the Reg A side, I think that does come in higher. You're looking at 1,500. The interesting thing with Reg A is that because these companies are coming in looking for such a large raise, certainly if they're in the 50 and the 75 million mark, they're actually looking for us to reach out to more of the institutional client base. So they're looking for us to reach out to the family offices, the VCs, the wealth managers. And we have a team of 4 investment bankers as part of Justly who do just that, and get out there. But when it comes to the CF side, it's definitely more around the 500 is probably the average that we're seeing. And again, it depends on the product, right? It depends on the company,
sure,
and so
sure,
forth, how passionate someone can feel about it.
And the fact that the issuers get to set their amounts. I mean, the
Right.
issuers saying, what are the minimum amounts? A lot of it depends on their offering, and a lot of it depends on, are those investors actually more than just my fans? They're my brand advocates. They're my evangelists. They're my customer base.
Yep.
So there's I think there's quite a bit different messaging and a different story that's going on now, where say it used to be, I want a handful of investors and give me a lot of money. Forget the fact that they might be yielding a big stick over my head to say,
Right.
Are you executing on something? Yep. And the mindset of having tens of thousands of small investors it wasn't that long ago when people said, why do I want 10,000 shareholders? Why do I want 1 million shareholders in a private company? Oh, that's going to affect the institutionals. That's going to affect somebody else. And it honestly never made a whole lot of sense to me. And I mean that. Yeah, I mean, there was friction points before that. It was hard to manage large volumes of investors. Technology takes that all away. That's right. That's gone. It's almost like, to me, and I'm not trying to be naive in this thinking, but I think the future says that if I'm a public company right now and I go, well, we don't want you to have 1 million shareholders on your cap table in a public company. Well, people would kind of, what do you mean? Why not? I want lots of shareholders in my public company. Yep. So if the technology is there and the desire is there and the will's there, why would I not want the same thing in private?
Agree. And I think
the whole idea of democratizing capital would let everybody should participate.
Yeah, that's what
at least have the opportunity.
About, right? The Jobs Act was about letting every individual investor get on that cap table and invest in a company where they feel they have skin in the game and they have a say. And, when you start talking again about ESG and impact investing, that becomes even more important because people want to be involved. I mean, you have companies out there like John's Crazy Socks, started by a parent for his son who has Down syndrome. They employ over 50% of their people have different abilities. And so people want to invest in John's Crazy Socks because they want to see that impact. They want to see those people with differing abilities get jobs. And they can do that by not just investing in the company, but then also buying the socks and sending them to friends as gifts. for Christmas and so forth. They really feel like they're part of that company. And I think that's the change that's come. That's the change that's come through ESG and impact investing is people want to know when they invest in a company, they're not just making a profit. They are doing good in some way or making an impact, be it environmental or socially. They want that. And as I say, the criteria that's coming along and the ability to evaluate that is the key element now in really truly moving that forward.
Well, yeah, I think you summarized it. I mean, it's more than the maximum financial return that the investors are looking for. It's going, how much do I need to make on this? I mean, we have enough things out there that allow us. Hey, I want to gamble. You can go do sports betting right now, and you want to hit out of the park. You can go into the crypto space and potentially hit out. Those vehicles exist.
Right.
I mean, this is at the other side of the ledger, so to speak, when I say impact investing. And the reason the institutions, they're allocating X amount of funds to impact investing. And I think more importantly, it's becoming, the risk is becoming minimized. The risk is minimized because it's making good business sense for a lot of these companies. It just takes a while for some of those industries. And unfortunately, a lot of the early entrepreneurs have to pave the way for the next entrepreneur. When we come to things like we touch on battery, whether it's battery technology or whether it's somebody that says individuals in my community can contribute amazing things and they can participate wherever they're from, and those can be financially successful companies to boot. These aren't just benevolent, endeavors. So I think it's again, when I hear these stories from different companies, that is truly the most exciting. And any entrepreneur out there, understand that these regulations, they're meant for you.
Mm-hmm.
And I'm passionate about this because we're seeing companies that had no chance. They said, you know what, I got it off the ground. I got on first base. I got on a second base. Now I'm doing significantly larger raises. And now the institutional investors are taking a hard look at me. They didn't want to start, and I'm not negating that, but let's be honest, a little bit risk averse for early on. So this just, evens the playing field for that individual entrepreneur to at least control their destiny and their journey as far as they want to, and then let other parts of the investment community invest. So there's different stages, different tranches, and
there's good. I mean, there's a company in the UK called Elvis and Crease, and what they do is make purses and wallets, and they make them out of old fire hose and old leather. These are all scraps. Basically, since 2005, 175 tons of discarded fire hose they have turned into wallets and purses.
Wow.
Right? They still make a profit. Actually, they give 50% of their profits also to charity, but they're still a profitable company and they are still doing well. So why wouldn't you want to invest in a company like that is making the world a better place, right? And taking stuff that we just naturally throw away and turn it into a very, very good product. It's a great product. Instead of buying another company that makes purses and so forth that is basically not doing anything really to help the environment and social and governance. Right. And that's the change. It can be done. And there's a lot of companies out there showing that way. And what's new, and you touched on this earlier with the new companies that are coming around, right? And is it easier for them to do ESG and do that governance and so forth? One of the reasons it's easier for them is they're approaching business in a different way. They're looking to see where the issues are and how can I change that? So Elvis and Chris were the same thing. Okay, I want to make purses and wallets. How can I do that a different way? Well, there's all this waste over here that we can actually repackage and turn it into a really, really good product. So it was a solution to a problem. And that's what's happening with a lot of these new businesses. They're actually looking at it that way. What is not working? And there's many examples of that out there if you truly look into it and dig around. And as I say, Justice's been going 8 months, right? We're an impact broker dealer. We are truly going to make a difference. That's why we're here. And as the more and more we dig into this, the more and more we look at it and we learn, it is amazing what can be done and what companies are doing out there. And as I say, the narrative is now changing towards this, and impact being the key element of that. People really want to start measuring that from the companies they invest in.
I agree with that. And I think you touched on something that I think makes a lot of sense to me is you've got a lot of startups, they're looking to solve problems, and a lot of them might find solutions to part of their problem to let's say in the manufacturing sector from another startup that said, we need to recycle rubber in a different way. And there's not some big Goliath out there that's saying, we're going to jump into the recycling business. Someone's going, it's that small company that says, we're going to do this. And that who is our customer base? Oh, we're looking at, as you said, the purse manufacturer that only wants this. So the supply chain start to evolve, even at a very nascent stage, but they start to, I think these small private companies that are ESG focused, they start to coalesce. I mean, right now the current infrastructure has been, okay, what are we doing from top down? And I mean, we've all heard about over the years. I think it's improved dramatically, but the whole idea of greenwashing and whitewashing and whatever we're washing just to be the word of the day, to be environmentally friendly, or things like child labor, for example, in certain manufacturing facilities. Let's be honest, it's been around for a long time. Why did it not change? Why is it taking so long to change? We know about these things. At the end of the day, we turn a blind eye and we look to see what the return on the investment is, until people start to realize that I can make a good return on my investment in environmentally friendly companies, in better corporate governance from a perspective of looking after, what are the labor issues that we're dealing with. And for those in the audience, when we start to drill down and say things like, the term, the environment, well, what does that really mean? Like the companies that are dealing with these things, is it resource depletion? Is it greenhouse gas emissions was, the biggest one on the topic? Is it plastic waste? All of these things, they're real. And I think, and they resonate, with a lot of people, and there are companies that want to help solve those. But I really, really believe it's going to be the tens of thousands of companies in the private marketplace that are going to make those changes. And hey, you've been in the capital markets for a long time. I don't think a lot of people are surprised. There's significantly more money being raised in the private marketplace than the public marketplace, which is declining.
Right.
It's declining when you look at the number of companies listed on the public stock exchanges. Why?
Yeah. And again, right, there's no need now for these private companies to go and become listed. In the old days, that was it, right? You start a business, and as quickly as you could, you wanted to IPO and get listed on the exchange. Now, the private side of the business is like, well, do I really want to be in that space? Do I really want to be listed? Do I really want to be governed a little more than I am being a private company? And I think the answer is no. And the original idea was being listed enabled you to grow and be bigger. And I think we've found over the last 10 years that hasn't been the case. And again, the private sector to the listed, when you touched on the E element, which you had down pat there, that's getting better to evaluate. Governance is pretty easy to evaluate, especially of a listed company, because a lot of it is around their political contributions, their lobbying, executive compensation, bribery, corruption, how the board's made up.
I mean, that's a whole other conversation, right? When you talk about that gets into the political realm of, geez, what's the function of lobbyists? When pros and cons. I mean, there's a big con there too.
But that's easily captured as far as being able to measure, right, for a listed company and also for a private company to a certain extent. the hardest thing when you start looking at the criteria in a private equity company compared to a listed is being able to get the data you require from a private equity company to be able to gauge their impact, right, and evaluate their impact. And one of the things that we've done at Justly is and there'll be an announcement hopefully in the next week or two, we've teamed up with a company called Proof of Impact. And Proof of Impact are solely work with private equity companies to be able to evaluate what they're doing and how to give them a form of ranking on where they stand as far as ESG or impact. Because we as Justly believe that anyone coming onto our platform that we are going to say is an ESG/impact company, it needs to be evaluated, and it needs to be evaluated by an independent group. So again, that's why we've kind of moved into that direction, because we believe it needs to be independent. There's too many people out there
it has to
criteria, which goes to your greenwashing and so forth. So again, hopefully anyone who's listening to this is aware of people of like As You Sow, Just Capital, two nonprofit groups out there that do a lot of work at evaluating companies that are listed. And it's important, if you really care about impact and you care about ESG, you should be following those two groups, because they do a lot of very, very good work around this space.
No, I think we're talking about the governance side of it, and it just got me thinking about a little bit of, I don't think it's out there. So private capital is being raised in the public. The marketing is all done, to the individual investors out there. Social media is certainly big from an awareness campaign about the individual companies, and maybe we can segue into that a little bit on how successful companies are raising capital and all the key stakeholders that they need, and on the ESG. And there's some discussions I've had with some individuals and firms where they've got some pitfalls. But on the governance side of it, that got me thinking was, what's your take on just the crowd at large, social media at large? I'm a private company, and we know some private companies today, and people are shocked when they hear this. Private companies with over 1 million shareholders on the cap table. Over 1 million shareholders, you're a private company because you can manage it from a tech perspective. But here's the other side of that. You also have social media that helps to keep these companies honest. They can be an evangelist, or they can be a detractor of your firm if you're not doing the right things, especially in the ESG space. So I think you can be called out quicker, faster, easier. So I think there's just the global community that does impact governance from that perspective as well in a private company. So I don't think the idea is to say I'm a private company, I can hide, you know what I mean?
No.
Because again, if you've got your customer base and they don't like what you're doing, saying, communicating, one, they're not going to continue helping you grow. And that's the interesting, when I say continue to help you grow, is the amount of reinvesting from existing shareholders in private companies was extremely surprising to me until we looked at the data.
Yeah.
And I go, wow, I've seen companies that go 70% of their shareholders reinvested through multiple rounds, transitioning from, say, a Reg CF to a Reg A, and companies are using these vehicles that need to raise a lot of capital. And in the ESG world, a lot of it's infrastructure capital.
Yep.
And those guys, I mean, that's a long time journey. I mean, so if you're dealing with infrastructure, and that wasn't really heard of before. I mean, to say, again, a private investor outside of the bond world, for example, but private investors, small investors saying, oh, I want to invest in this firm that's building something in my community, then maybe they'll be able to have multiples of it in multiple communities. Mm-hmm. But as they're doing that, they're reinvesting when they see the progress.
Right.
And that's compelling. It's not just like a one time I'm done and I'm going to hold on to it for 50 years. They're reinvesting because it may be 50 years. And I think a lot of people aren't aware that one of the biggest changes in the private market is Hey, I've got a lot of old share certificates that sit in my bottom of my drawer, and I go every once in a while you pull them up and you think maybe I can go on the internet and see whatever happened to this firm, but today, right now, that that ability to have some liquidity is existing, and that's the other side of those regulations.
Yeah, I think there's two aspects to what you were saying there. The first one, I think, I remember reading a sales book many years ago called Raving Fans, and that's the key element, right, of any business, is that you have the people that follow you, they love what you do, they're the ones who sell you better than anybody else. And so when you have investors that are happy, who are continually buying into your company, they're also spreading a good word about you. So I think that's the key element. And again, like we said, when it comes to private equity, in a lot of cases, it isn't always about profit. It is the impact element. So there is that emotional attachment more. So I think in as we're talking about ESG, there's more emotional attachment to those companies. And therefore, if you're doing the right thing by the investor is going to be a raving fan and speak to that. The other aspect that you were just touching on, and how the private equity market is going to grow, and you know more than anyone from your position at Karrlsson to have seen how quickly this has taken off over the last 10 years, is ATSs, the secondary market coming in to private equity. That will then bring liquidity. So people will be more, at the moment, as you know, with private equity, you buy it, you keep it until they either get bought by someone or hopefully they become an IPO, right?
Mm-hmm.
If you start bringing in these ATSs, and there's a few around now where the investor is able to get out or even buy more shares, that then becomes even more interesting to the investor. And again, we talked about risk and return. Part of the risk in private equities is you can't get out. Those ATSs will change that, and that will be the next movement in this space. And it's something, again, Justly is looking at doing and hopefully having in place before the end of the year.
Yeah, we mentioned liquidity, and I'm looking over here because there's some individuals who are making some comments in the chat that maybe I'll try to jump in and try to read and talk at the same time, but I'm not very good at that. I'm not one of those guys that multitask. I think there's a fallacy to that, but some people maybe. But on that impact side of it, though, as far as that the investors go, it is that coffee table talk. It's when you see progress, and I think when you see progress in a community where somebody might be, they may be a company that's using recycled materials to build playgrounds, and they make that announcement, and somebody says, hey, you know what, I invested in that company, and they're building playgrounds all around the world, and they happen to be using recycled rubber for these playgrounds, or they're doing something, from an impact perspective that they resonate with. And they go, you invest in that? Can I invest in that? That's the groundswell. You mentioned what companies like Core has seen, and the Jobs Act has evolved for the 10 years. Yeah, it's one of these 10-year overnight awareness things. And it hasn't been for the last 2 years. And COVID was a big impetus for that, where people were sitting at home and said, I didn't know I could invest in that. Heck, I didn't know until I saw a number of companies that we get introduced to, and whether it's through education or whether it's through actually they're saying, hey, how do I make this happen? I didn't know that any of these companies existed. And at the end of the day, it's building and building and building. And it is the funding portals that exist. It is the broker dealers that exist. It is the investor acquisition firms that exist. I mention all of these intermediaries because one of the questions that comes up when any company, not just ESG space, they're going, how do I make this happen? How do I participate? Mm-hmm. Well, you need teams. I mean, at the end of the day, I mean, you need, and there's specialists that are emerging in Reg A and Reg CF offerings. I mean, mm-hmm. I relate it to much like my family doctor. My family doctor sends me to a specialist. My lawyer sends me to a specialist. My accountant sends me to a specialist when it comes to certain things. And I think issuers have to look at it that way. The technology is streamlining things. The awareness is getting better for these things. The awareness and the desire from the general public, again, in the ESG space, is saying, they're asking the questions. They're
Right.
saying, okay, what are you doing beyond just making me a dollar? And when it comes back to the liquidity side of it, yeah, let's be candid. The ATS is in their nascent stage.
Oh yeah.
And you need a buyer and a seller for whatever you're doing. But the fact is, it never existed before. So
Correct.
when I talk about this 10-year journey, and all of a sudden the last 24 months, I think there's been like a 400% growth in Reg A filings for companies that want to rate private companies $20 to $75 million, raises. It says something's going on, right?
Mhm.
So there's the awareness both at the issuer side, there's an awareness at the public side at the same time. But at the end of it, it's constant education. It's like doing what you're doing. It's doing what these chats are meant to be. It's
Yep.
just opening that dialogue. Gentleman here was just chatting, and it was will hold companies accountable via blockchain. He made a comment, and it was like, when cheaply made items made by children, we hold companies accountable via blockchain. So obviously, I think it was alluding to the fact that blockchain is a piece of technology that has good and bad with it.
Mm-hmm.
But the brilliant thing about it is that immutable ledger capability to manage and track so much different bits of data, whatever purpose you might have, whether it's managing shareholders, whether it's managing supply chain related issues, whether it's dealing with contracts. It's just streamlining things. I mean, some people go, well, if I lose my job, what's the new job? Well, the new job is the new job. And I think we all have to recognize that. Changes don't make things, they open up new opportunities. And that's the hard part.
Yeah. I mean, touching on various points that you had there, I mean, you made me start thinking of when I used to work in the business in the UK, and the US went electronic trading, and the London Stock Exchange floor was, no way will London ever go electronic trading. It's just not going to happen. And within 5+ years, they were electronic trading, and the floor ended up being actually, I think, a very nice restaurant. So change does happen, and not everyone embraces it straight away. The ATS is a move in the right direction. It's not going to go away. It's the same thing with, loads of people said that you wouldn't have Bitcoin around by now, and Bitcoin is still around in various forms of it. Mm-hmm. You know very well with blockchain, because you guys use blockchain. And I love blockchain. I think blockchain has a lot of opportunities, and again, part of it is it's all about money. Again, we touched on this at the very beginning, and the change of mentality. If you look at blockchain is the solution to equity settlement, and equity settlement going to zero. It is the solution if people want to embrace it. But if you embrace it, one, it costs money to do so. Two, how many jobs would disappear? How would certain companies no longer dominate a space if they give into that? And that's the problem with some of these things. And again, ESG is no different from what we said. When you've got a company that's been around 50 years and you're asking them to change, the questions in them is, do I lose being number one? Do I lose this? Do I lose this? Is it going to work? That's the problem with any new technology. Blockchain is a solution, and a very good solution. And I don't think we've even come close to what that truly means down the road.
Yeah, you touched on a lot of different things there. I mean, I think too often we think of anything that's legacy based. Whether it's the financial markets, whether it's a small company, it's not a zero sum game. It doesn't necessarily have to mean that if I'm in the coal industry, and where are all these employees going to go? I mean, there's big political debates on all that, and there's the environmental green guys want to do this. Yeah, there's cost but it's change. Mm-hmm. And I look at things really a little bit pragmatically from a perspective of, hey, if I was living in the 1700s and my kids had to work at under 12 years age. And was that a good thing or a bad thing? Well, darn, it's a bad thing. Today, everybody goes, well, that change was good. I think we're going to see the same thing 50, 100 years from now, where people are going to be going, the change that occurred, I can't believe we did that, is what people are going to say. It's no different than in the medical community, where people go, oh my gosh, we seemed so backwards back then. But it was the best that we had. But progress doesn't necessarily mean people are losing their jobs and moving out. And I know that's a big issue when it comes to the environment and the ESG space. And it doesn't have to be that way. I mean,
yeah. I mean, industry as a whole, right? And there's examples of this everywhere. I mean, my example I always use is Norton and Triumph motorbikes out of the UK. They were the best motorbikes in the world. They knew they were the best motorbikes.
Don't the Harley guys argue on that one? I don't know.
Not back then. Not back then.
I'm not a bike guy, so I can't.
Right, not back then. But the Japanese kept coming up with bikes, and Norton and Triumph were like, they're not nowhere near as good as us. The problem is Norton Triumph did nothing to keep moving that product forward because they were the best. And they didn't believe all the other things coming around them were going to impact them. And then what happens is they get in financial trouble and everybody else overtakes them. And, one of the lucky things in my life is I work for Fidelity, and I had the honor of speaking to Ned Johnson 2 or 3 times and working with him on various products. And the one thing Ned always believed in was Kaizen. He's a massive, loved Japan, loved the culture. And Kaizen, what Kaizen moves is continually change, just small changes, but continually move forward. And if you do that, you never get left behind. You're always open-minded. And I think that is the key element here. Do you jump into blockchain? I'm not saying everyone should just dump everything and go into blockchain, but blockchain has a lot of value. You should be looking at it, and we shouldn't. And that's the difference. The difference going, hey, the old way is the good way, and that's what we're going to do. You need that Kaizen element. You need to always be looking to grow, looking for change, and making sure that you are always relevant.
Well, I think we know the blockchain is completely. That's a huge conversation in so many different directions, and
I'm definitely not the right guy to have on.
No, and a lot of people are just really. There's a lot of misinformation. A lot of people are confused. A lot of people think blockchain is Bitcoin. Blockchain, it's tokens, it's coins. Yeah, that's a piece of the puzzle. Those are end results of blockchain. That's not what blockchain is.
Right.
And you're right. At the end of the day, it's all about efficiencies and it's all about improving things. But you hit a really, really good point. And for those of the, whether they're listeners or just people in general, or just when we're sitting and having coffee table chats with friends that go, well, what about, you hear these, there's 2 political sides of this, and it does, unfortunately, politics does affect the ESG world, at large. So you've got one side going, what about all of these, those old jobs? What about the miners? What about the gas? What about the coal mines? What are they going to do? And I would just think, you ask anybody, any of those families, you say, do you want your son or daughter doing what you had to do or your grandfather had to do 50 years from now? And they're going to say, well, no, it put food on the table and it did these things. Respectfully, those are great jobs for your family at the time. But today, going forward, and this is me going on a little bit of philosophical or political tangent,
right.
but today, technology is going to bring those new jobs. It's going to bring those healthier jobs. It's going to bring those for everybody. But there's a lot of friction points along the way. You can't just flick the switch and say everything's green, windmills are better, this is bad. There's going to be bumps in the road. But the last 100 years were huge bumps in the road. And it's that continuous improvement, as you just said, from an individual level. I think we as a societal level and as people have to say, okay, this is going to affect me a little adversely today. How bad's the pain point? But tomorrow, the next step and generationally, it will be better because it's gotten better. So I think just having these discussions, I think, are extremely important.
Yeah, and I think, like you said, we still need coal. right? We still need oil. We're not there yet. But what should be happening, and I think, we touched on this at the very beginning about private equity companies starting up with new solutions to problems. What I do see happening, and we've got a couple in the pipeline right now that can work with coal companies and take the coal that's normally just dumped and is treated as rubbish. They can turn that into another valuable piece of a commodity, right? So there's a change there. That's a positive change. You're still doing coal. We haven't got rid of coal, but we can make more of what we are currently doing. And when those companies start working together to the solutions that we need further down the road, it's not a big jump. You're not saying, okay, we no longer got coal and all these people are out of work. You're working in a way that is with a focus on making something better.
It's not a light switch
element. Just let's know where we want to be in 5 or 10 years, and let's put that in place, and then we can re-educate people, right, of how to do this.
And those companies are now part of the change. Those companies that already exist.
Yeah.
Hey, I'm a Canadian. Oil and gas was a big part of where I went to school, but those companies are now. They're looking at how do we change? Mm-hmm. How do we evolve? They're not going to sit there. They don't want to be a dinosaur. I mean, we see too many companies that didn't want to change because it was always done that way. I mean, it doesn't even, not even the non-environmental, spaces. I mean, we look at the Kodaks and the Blockbusters of the world and said, what happened? Well, they didn't want to change because who's going to change this? Oil and gas, coal, labor forces that are going on from a manufacturing sector. Hey, if somebody says, I'm not buying your shoes because you've been exposed, from a child labor practice, that's going to affect your bottom line, and your bottom line is going to drive the directions that a company is going to take. So I think that some of the latest data that I heard was from large corporations. It was like 25 to 30% had like a 4-star rating if they wanted, whatever the classifications were for some of the rating agencies that you've talked about. So there's a long way to go. But private companies today, I think, have a leg up. They have a leg up to be the new, and whether you like it or don't like it, but they have the opportunity to be the new Teslas of the world in their space. You don't have to be a big Tesla, but you can be as big as you want to be, and private capital raises will help do that. And again, I think part of the awareness from the crowd, and that again, the ability for individuals to participate, and the ability for issuers to participate, perhaps some options.
Right.
I think that's the big message.
Yeah, but I think as a broker dealer, I kind of have to throw this in there. Again, the investor has to make sure that they know what they're investing in, right? They still need to do all the relevant research on these companies, make sure it's something that they should be invested in, and can afford to invest in. But the opportunity is great.
Yeah, and I think you said and can afford to invest in. I think the regulations are there to also. The reason there's regulations to help protect the investors. I mean, because there are limits and caps for the individual investors, but they do have choice. And you're right, as a broker dealer, which is absolutely critical, as far as the intermediaries and the ecosystem for these regulations. Some regulations you don't need a broker dealer. I shake my head and I go, you better have a broker dealer. There's more to it than you think. Go and try to manage KYC for 10,000 people one afternoon, and you'll see what I'm talking about. But come back and taking a step backwards and looking at the investor and the messaging is another important step here. So one of the things for issuers out there, you said the investor needs to understand what they're investing in. The issuer also has to have a different narrative, because I need to be able to speak to you with the reams of data that are out there, with the distractions that are out there. I need to be able to tell my story. So people ask me, what are the successful issuers doing? And I said, well, they're hitting their raises. I guess they're successful, but they're hitting their raises because they're not selling data. They're not just selling financials. They're not just selling the potential to make money. They're telling their story. They're saying, this is where we're at. This is where we'd like to go. This is how you can be part of our journey as an individual investor. And if you're not telling your story, I think you're going to be struggling if you're just giving the data. You know what I'm saying? You need to inform, and the regulations say, hey, you've got to inform the investors about your investment because you need to protect them. But with only so many minutes or hours or days in a week that an individual has, they're going to say, what's going to grab my attention? And
I think that's the key thing when you start speaking to issuers that are looking at CF, Reg A, or even Reg D. One of the things that we always tell them is, hey, there's no guarantees here, right? You may be on our platform, you may be out there, you may be doing your raise. There is no guarantees. And the key element is exactly what you said. The issuer has a huge role to play in this. Not just the platforms, not just the broker dealers like ourselves. The issuer has a key role. They have to be out there. They have to have the right message. Now, we'll help. As I say, we have an investment banking team. We have a marketing team. We'll help with that message. But we can only do so much. The issuer has to have a good message, has to be able to punch above its own weight to get that information out there. And I think that's one of the things that some private equity companies don't understand when they come into it. They come in, they have a TA like you, they have a legal group that gives them the Form C and the Form A. They get past the SEC who say, yep, you're a good company, people can invest in you. They get on a platform like ours, and then they think that's it. And it really isn't. There is a lot of work that has to go into this. And again, the ones that are successful, like you said, have a very good message, but they're also out there pushing and pushing and pushing behind the scenes.
Yeah, the vehicles are there, right? I mean, the vehicle is there. You can reach, I don't know how many, what's the size of the global investment crowd, because you can get investors from around the planet. You've got like 2 billion people. Now you got to communicate with them.
Right.
Now you're going to narrow it down, obviously, and depends. But again, the messaging is who's going to hear your voice in the most cost-effective manner.
Yeah.
And again, with today's conversation was on chat, which I thoroughly enjoy. I'm passionate about the space. I love this. But in the ESG space, who hears your message best? This wasn't as specific, but I think it's analogous to the ESG space. I had the opportunity at a medical summit a couple weeks back, sitting down with physicians, and some physicians that were entrepreneurial in nature, serial entrepreneurs. They just happened to be physicians, and they were in some high medical tech spaces. And a comment that was said, and I bring it up because it's touching the audience that relates to you. And the doctor had said to me, he said, you know what I really, really like about this, Peter? He says, my nurses can invest. And I said, what do you mean by that? He goes, I've been doing this for a long time. Besides my practice, and he's a surgeon, he goes, we created all this intellectual property and patented materials, and we created companies. And my nurses go, doctor, how come I can't invest in your companies? And they couldn't invest.
Right.
And I'm going, so what is this giving you? And he's saying, well, I have the ability to reach out to, one, people that couldn't invest, but two, that understand the impact. So I bring this back up because it was the impact that physician was going to make in the quality of lives of individuals. And those that knew the impact better than anyone else were those that couldn't invest in his company. And it was all the nurses that dealt with it every day. That, to me, that's when you talk about focus on your audience.
Yeah, and I think that's the key thing. I mean, that's, again, something that we tell investors all the time, certainly on the retail side, is, invest in what you know, right? So that would be the nurses, right? Invest in stuff that's in the medical field that you know if it's going to be good, bad, used, right? And now, like you say, because of the Jobs Act, they have that opportunity, which is great. And also invest in stuff that you're passionate about. If you're normally passionate about something, you already have done your research, you know about it. But that example you gave is perfect for what crowdfunding and the Jobs Act was really trying to do, is get people, the normal investor, being able to invest in opportunities that very only a select few used to be able to get into.
And impact related. So on that note, I think we're at the top of the hour. It's a pleasure, Paul. Core talks are going to continue every few months. I hope that we can have another chat like this. And it's been a lot of fun.
Thank you very much, Peter.
Any closing thoughts to?
I think what I would leave with anyone with the ESG is it's going to change, right? And it's not a perfect world right now. More and more criteria is coming in. More and more companies are coming in and looking at the criteria and being able to evaluate it. And that's what you need to do. If you're getting into this space, in the impact investing space, do a little bit more research. Make sure you use the tools out there. Make sure you're using the proof of impact, or as you sow, Just Capital. Use that information, because there's a lot of companies out there can help guide you and give you detailed information.
Starts with education. On
really
that note, I will let you go. And again, absolute pleasure. Thanks so much.
Excellent. Paul. Thanks, Peter.
Bye-bye.
Bye.